Imagine this. You've been doing everything right. Every payday you set money aside. $50 here, $150 there. It feels good. It feels responsible. But then one day, you check your account and something hits you. You've got $8,000 saved up. And last year it earned you less than the cost of a nice dinner. Meanwhile, your friend mentions their investment account grew by thousands in the same time. And suddenly, a question creeps in. Am I actually building wealth, or am I just storing it? Here's the truth. Saving protects you. It does not grow you, and most people never figure out how to move from one to the other. So today, we're mapping out the exact path from saving to investing, step by step, without gambling your safety net. I'm Daniel. If you've got money parked in savings and you're ready to make it work harder, hit subscribe, because this is exactly what we cover here on. Let's start with an uncomfortable fact. If all you ever do is save, you will likely retire with far less than you think. Not because saving is bad. Saving is the foundation. But a foundation isn't a house. Here's the split you need to understand. Savings preserve value. Investments create value. Two completely different functions. And confusing them is where most people lose years of potential growth. Let's run the numbers. Say you park $8,000 in a savings account, earning 1%. After a year, you've got $8,080. Fine. Now let's put that same $8,000 into the stock market, averaging a historical 9% annual return. After 1 year, you're looking at $8,720. Doesn't sound dramatic yet, right? But stretch it to 25 years. At 1%, your $8,000 becomes about $10,300. At 9%, it becomes nearly $69,000. Same starting point, wildly different destination. And here's the part nobody talks about enough. It's not the gap between spenders and savers that creates real wealth divides. It's the gap between savers and investors. So why doesn't everyone make the jump? It's not a math problem. It's a nervous system problem. A savings account feels solid. The number only goes up. It never drops on a Wednesday morning because of something happening on the other side of the world. Investments do that. They move. And that movement, that unpredictability, is enough to keep millions of people stuck in safe mode forever. Now maybe you're thinking, fair enough, but I'm not risking the money I worked hard for. Good, you shouldn't, not carelessly. That's why this transition happens in stages, never all at once. Let's break down the path. Step 1. Lock in your safety net first. Before a single dollar goes into investing, you need 3 to 6 months of expenses sitting in cash, untouched. This isn't investment money. This is your life happens fund for the layoff, the surgery, the car that decides to die on a Tuesday. Here's why this step gets skipped and shouldn't. The number one reason people sell their investments at a loss is because they suddenly needed that cash and had nowhere else to pull it from. Your emergency fund exists to protect your investments from your own life. Step 2. Split your money into 2 identities. Call one protection money, call the other growth money. Protection money stays flat, stays boring, stays untouched. Growth money is allowed to rise and fall, because rising and falling over time is literally its job. Once you separate these mentally, the anxiety of watching the market dip disappears, because that money was never meant to sit still. Step 3. Start ridiculously small. This is where most beginners talk themselves out of investing. They think you need $5,000 to begin. You don't. Most platforms today let you start with $25, sometimes less. The point at this stage isn't the return. It's building the muscle. Because consistency beats timing every single time. Step 4. Keep your first investments boring. Beginners often want to jump into the exciting stuff. Options, day trading, the latest crypto trend. But the data tells a different story. The most boring strategy usually wins. Take index funds, for example. Instead of betting on one company, you're spreading your money across hundreds of them at once. Less risk, steady growth, zero guesswork. Even Warren Buffett, arguably the most successful investor alive, has said most people would be better off in a low-cost index fund than trying to pick individual stocks. Here's the part that surprises people the most. The most effective investing strategy is almost boring on purpose. It's called dollar cost averaging, investing a fixed amount consistently, no matter what the market is doing. Let's say you invest $250 every month. At an 8% average annual return, after 25 years, you'd have roughly $237,000. But here's the wild part. You only put in $75,000 of that yourself. The other $162,000? That's growth, working on your behalf while you slept, worked, and lived your life. But let's be honest, discipline is the hard part. Because when the market drops 15% and every news headline is screaming panic, staying calm feels almost unnatural. This is exactly where investors separate from gamblers. Here's a way to picture it. Saving is like keeping water in a bottle. It stays exactly as it is, safe, contained, unchanged. Investing is like pouring that water into a garden. At first, it just disappears into the soil. Nothing seems to happen. But months later, you're not looking at water anymore. You're looking at something that grew. Now you might be wondering, what happens when the market crashes? Because it will, at some point. Here's the insight that changes everything. Downturns aren't the enemy of long-term investors. They're actually an advantage. When prices drop and you keep investing that same fixed amount every month, you're simply buying more shares at a discount. When the market eventually recovers, and historically it always has, those extra shares work in your favor. This is why experienced investors don't panic during a dip. They're playing a decades-long game, not reacting to a bad week. So let's bring it together. 1. Build your 3 to 6 month emergency fund before anything else. 2. Mentally separate protection money from growth money. 3. Start small, but start consistent. 4. Keep your first investment simple. Think index funds, not gambling. 5. Stay disciplined and let time do the heavy lifting. Because here's what it comes down to. Saving gives you safety. Investing gives you freedom. And the sooner you stop choosing between them and start doing both, the sooner your money starts working as hard as you do. If this gave you a clear next step, hit subscribe. We're breaking down real financial strategies here every week on. Quick question for you. Are you still in saving mode, or have you already made the jump into investing? Drop it in the comments. I read every one.